And there still seems to be an ongoing rolling thing. It's like the broken banking system globally. And Citibank is one of those. It just looks like that. It never recovered. I mean, it just fell like a stone and then it's been trading sideways ever since. And that cliff or that plateau feels like it just wants to jump off that. So I don't really know what, well, we know why. Rates are too high, the yield curve's inverted, the banking system's not fully functioning.
Today, Raoul Pal discusses the imminent banking crisis, which he believes is on the verge of worsening. In his view, we are just a few short months away from a severe financial event. The fragility of many countries' monetary systems underscores the severity of the situation, and rising inflation rates further emphasize the growing instability within these systems. Raoul emphasizes that the real impact is affecting people's ability to afford essentials like homes, food, and energy. There's a looming possibility of a massive run on the banks, with several major institutions, including JP Morgan Chase, Citigroup, and Bank of America, potentially facing this crisis head-on. Raoul suspects that many banks are already functionally bankrupt, propped up by accounting practices that may become evident as more banks encounter difficulties in the coming months. To delve deeper into Raoul Pal's insights, including his market forecasts for the end of 2023 and his discussion on the pivotal role of cryptocurrencies in the global financial and stock markets, let's jump into his latest interview.
Markets are just sloppy. There's nothing really going on. There's no new money around. Everybody's in the Hamptons. All of that kind of stuff is going on. So you have to be patient in summer markets. And usually, once you start getting through August, September, things start kicking off. The things that I'm looking to kick off are as rates have been decoupling from the market. So I actually got stopped out by bond trade. Finally, I got out of that bloody pain. It was a terrible position because bonds basically decouple from the business cycle this time around. It's nothing to do with inflation. It's actually to do with liquidity because of how the Fed the Treasury are issuing so many new bonds to pay the interest on the bonds because rates are so high. They're doing it in the bills market. That's draining the reverse repo, but it's still flowing through into the rest of the bond market, and yields have been rising. That whole process has started pushing the banks lower again. So I'm keeping my view has been, and it's not a precondition, but my view has been that we're likely to see the banks starting to fall. I'm looking at, for example, I put on Twitter the long-term chart of Citibank with the cliff of death. Looked like all of the European banks did. I've been looking at Bank of America, doesn't look great. And then the regional banking index, the KRE. So that would be a tipping point that would start changing the equation. What else can uncouple markets? Well, the bond yield issue in itself could uncouple markets. But what it's telling me is we're getting closer to more cowbell. That point where the Fed have to go, oh. And that happened last time, if you remember, in December 2018, when suddenly the repo market broke and the Fed was like, we're stopping QT, and we're not going to hike anymore. And then they started cutting 6 to 9 months later. We're in that phase, I think. Let's see what Jackson Hole has. Powell still thinks he's Volcker, and it's a ridiculously different environment, but that's what they want to believe right now. So my guess is that the payback for this is, I think they're going to undershoot inflation. So I'm strongly of the opinion inflation is well below 2%, maybe even as low as 0 by the end of the year. And that's been my call for a while now. And I think core inflation goes to 0 by summer to this time next year. So I think we've got all of the inflation domino to play out from the GMI business cycle dominoes. We have, I think, a rise of unemployment will come over this period. I don't think it's going to be huge because there's some complications in the labor market as people are leaving the labor market, etc. And I think, rents are coming down, all of that stuff. So what we're likely to see is the Fed going, oh my God, sorry, we've undershot, which gives them the cover to cut rates, which they need to do because they cannot pay the interest on the debt at these levels ongoing. They've got about 13 trillion of debt to roll over plus new issuance. They need to get rates lower and they need to then monetize the interest payments. That's part of the Everything Code thesis, those of you who've been following along at home. So the Everything Code thesis suggests that Q4 is going to be when this start of action starts happening and we don't, maybe QT stops, maybe we get a rate cut, maybe we don't, but we start flagging it. And then we start to see, I think, another leg of the economic slowdown. I think we're actually bouncing out the forward-looking indicators of the ISM, all of this stuff I've been talking about in Pro Macro on Real Vision. That's where you get all the juicy stuff. So you guys watching this, most of you are Pro Macro subscribers, so you don't get all of the research that I put together, but we do a lot of stuff. And that's suggesting that we are going to see a sharp economic rebound. That was forecasted by liquidity and the GMI Financial Conditions Index. It is starting to slow down a bit because of these yields and the dollar stabilizing. And so that suggests that Q1 next year, so we might get a pickup in growth at the end of this year. Now, that won't come into GDP. GDP's lagged. Everything kind of lags in this. So GDP should be weaker in Q4. I know that the Cleveland Fed have this ridiculous 5.9% number. That'll go away. But we should see GDP low, but the forward-looking indicators, stuff like ISM, start to pick up. And then we might get another slowdown within Q1. I think at that point, the market is more focused on the cowbell, more stimulus, etc. And then we're into the full election year, and the full election year is cowbell central, because then you've got stimulus to try and bribe the voters, rate cuts to bribe the voters, the use of the balance sheet to try and not get the Treasury to end up with ridiculous debts on there, trying to issue ridiculous amounts of bonds and the market not be able to do it, and crowding out the private sector. Sorry, I'm speaking very fast because there's a lot in the everything code and I can't really get it across in a very short thing. Anyway, all to play for Q4, when it gets interesting. Everyone needs to get back from holiday, and then we can see from there. Well, real yields are a real issue. They're too damn high. I mean, they're super high right now, and that is going to continue to erode inflation and economic growth going forward. So my view is that countries high in debt cannot run long-term positive real yields, and the trend rate of real yield is probably negative 1%. So I think in the next cycle, we go back to trend rate of real yields. And I think that is the only way you can get around an aging population with massive debts. And we see that all over the world. So I think what we're seeing now is an aberration and not the trend. I understand that most people think the opposite, but hey. Raoul, John Kitchener, love to hear your thoughts on Citi. I don't know, but I've used these very long-term charts of banks since the European crisis in 2012. And I've called it the cliff of death. And one by one, many of these banks have gone over the cliff of death, and that they needed to be bailed out. When it was the Italian banks, the Spanish banks, the German banks, the Swiss banks, and there still seems to be an ongoing rolling thing. It's like the broken banking system globally. And Citibank is one of those. It just looks like that. It never recovered. I mean, it just fell like a stone, and then it's been trading sideways ever since. And that cliff, or that plateau, feels like it just wants to jump off that. So I don't really know well, we know why. Rates are too high, the yield curve's inverted, the banking system's not fully functioning, etc., etc. So there's a lot of reasons why not to like banks, but cyclically, at this point, they should start to improve once the yield curve improves. Banks aren't always negative, and as soon as we start to get the yield curve steepening and rates coming, then banks tend to do okay, so that's usually fine. What are your top 3 trades? John Floyd. John, my trades, I'm not a trader really. I think you've probably figured that out by now. My time horizons are very long. So for me, it is number 1 crypto over my time horizon. Let's just use this business cycle, not even going further out. Let's say over the next, into end of 2025, I think crypto is the best performing asset in the world. I think technology stocks are number 2, and number 3, tricky, could be something commodity related, copper. Let's go with copper. That's what I think. And no, I don't think commodity prices rising in a business cycle significantly inflationary. I know everybody gets caught up.
In summary, Raoul Pal sheds light on the rapidly escalating banking crisis and its potential ramifications for the global economy. His insights into the impending financial event and the potential role of cryptocurrencies in reshaping financial landscapes are truly enlightening. We trust that this conversation has provided you with a deeper understanding and valuable insights into the unfolding economic scenarios in these turbulent times. Staying well-informed is essential for navigating the complexities of the market effectively. For more Daily Dose Crypto news, check out these 2 awesome videos on your screen. Click now and we will see you on the next video.